requirement number 2, prepare journal entries in the books of Puma Company. Only in the books of Puma Company under the cost model and under the equity method. So under the cost model, actually during the year, we are required for entries in both years for cost model and equity model. So for in the cost model, there are no entries so far in 20X4 regarding recording of dividends because there were no dividends declared. And we have to understand that under the cost model of accounting, we debit to investment account in the books of the parent upon acquisition. So we debit to investment account and to credit cash or any appropriate account. While in recording dividends, there is no entry affecting the investment account. I'm still talking about the cost method. So you only debit to cash and credit to dividend income or dividends receivable. You do not use the investment account. On the other hand, if you receive um, share in the net income of the subsidiary, again, you have no entry for that matter. But on the other hand, if you are using the equity method, by the time you invest, you debit to investment account and then you credit cash or any appropriate account. By the time you receive dividends, you debit to cash and you credit to investment account. So in other words, your investment account will be credited for that, which will reduce the investment account. On the other hand, if you receive share in the net income of the subsidiary, you are going to debit the investment account and you credit income from subsidiary or investment income. So likewise, that will affect the investment account being a debit that will increase the balance of the investment account. So at the end of the period, you will be asked how much is the balance of the investment account. If you use the equity method, the investment account will have a balance that's still equal to its cost. While if you use the equity method, the investment account will be adjusted depending upon dividends and net income of the subsidiary. So that's why we call it equity. Okay? So, in the problem, in the books of Puma, under the cost model, of course, the only entry made in 20X4 was to record the investment. But with regards to dividends, even in 20X5, there were no dividends declared by the subsidiary. So, but under the equity method, in the year 20X4, the subsidiary declared an income equal to 400,000. It's given in the problem. Separate reported net income of Smarte is 400,000. We have no entry for this under the cost model. But under the equity method, we are now in requirement 2 letter B. Under the equity method, we now debit in the books of Puma, debit, okay, net income, here as stated, the results of operations of Smarte, net income, dividends if any, and amortization of allocated excess and intercompany profit. So we now debit for 320,000. The account is debited to investment in Smarte. 320,000 investment in Smarte or investment in S for 320,000. That's 80% of 400,000. And credit to subsidiary income, you may credit investment income, or you credit equity in subsidiary income. So either of these credits, debit, subsidiary income, credit investment income, or credit investment in or equity in subsidiary income. That's for 20x4. So I'll repeat the entry in 20x4. Debit to investment in Smarte, 320,000, and credit equity in subsidiary income for 320,000. Okay? There are no dividends declared whatsoever. There are no amortization to be allocated. So, again, your next entry will be in 20x5. Your next entry, by the way, in 20x4, 20x4, we debit to equity in subsidiary income, 36,000, and to credit investment in Smarte for 36,000. That's for the unrealized profit. That's for the unrealized profit. Unrealized at the end of 20x4. But this will be realized in 20x5. So the last entry in 20x4 is to debit equity in subsidiary income, 36,000, and we credit to investment in Smarte for 36,000. Now we have the amount of 36,000 already recorded in our computations above when you were given the realized profit beginning of 20x5. So we now get the figures for our entries. Then in 20x5 to follow, in 20x5, the first entry is to debit again investment in Smarte for 368,000. For 368,000. 368,000 is taken by multiplying 460,000 by 80%. 460,000 times 80%. 460,000 times 80% is 368,000. Debit, investment in Smarte, and credit equity in subsidiary income. No dividends declared whatsoever. So our next entry will be entry still 20x5. The first entry is to debit investment in Smarte, 36,000. Investment in Smarte, 36,000. And to credit equity in subsidiary income. Credit equity in subsidiary income for 36,000. This is the same amount of 36,000 that we credited to investment at the end of 20x4 because that time the inventory was still unsold. In 20x5, the inventory was already sold. So the first entry is to debit investment in Smarte and to credit equity in subsidiary income. Second entry will be to debit equity in subsidiary income, equity in subsidiary income by 50,000 and to credit investment in Smarte. Debit equity in subsidiary income, 50,000, and to credit investment in Smarte. Now, this is to record the unrealized profit in ending inventory. This is to record the unrealized profit in ending inventory. Since, again, by next year, 20x6, this will be converted to realized profit. Okay? So those are the entries in 20x4 and 20x5 in connection with the books of Puma Company. Then we go to requirement number 3. Prepare the journal entries to record and as well as to eliminate the effects of the intercompany sales for 2 years. So we now begin with 20x4. In 20x4, to record the intercompany sales, we now debit to sales 1,080,000, sales 1,080,000, and to credit purchases or cost of goods sold. Debit sales 1,080,000 and to credit purchases or cost of goods sold or cost of goods sold. So we have now your first entry, 1,080,000. And as stated, Puma sells merchandise to Smarte at 20% above cost. And during 20x4 and x5, you are given the intercompany sales, and at the end of 20x4, Smarte had 1/5 of the goods purchased remaining in the ending inventory. So if you now multiply 20% of 1,080,000. So 1,080,000, you multiply that by 20%, that will give you 216,000. That's now your ending inventory. If the ending inventory is 216,000, as stated, it was at 1.2, no? Because the goods were sold at 20% above cost. At 20% above cost. Now take note of that statement that Puma sells merchandise to Smarty at 20% above cost. And that the ending inventory that we have is 216,000. If the ending inventory at cost normally, no, is 216,000. Now, you consider that as 20% above cost. So, how did we determine the the unrealized profit at the end of the year? If the ending inventory is 216,000, the cost of that is taken by dividing 216,000 by 1.2, since the goods were billed at 20% above cost. So, if 216,000 is the billed price, the cost of that is taken by dividing 216,000 by 1.2. So, it's only equal to 180,000. That's why the unrealized profit is 36,000. So this is how we got the unrealized profit in the first computations. The unrealized profit is 36,000, which will eventually be realized in 20x5 for the unrealized, now becoming realized in 20x5. So our entries in 20x4, number 1, we debit to sales to eliminate intercompany sales, 1,080,000. Credit to purchases or cost of goods sold by 1,080,000. Okay? Then the second entry will be to debit cost of sales, for 36,000 and to credit inventory. Debit cost of sales for 36,000 and to credit inventory. As I have given you how we arrive at 36,000, 216,000 minus 180,000. Now we go to 20x5. In 20x5, your entries are to debit, number 1, sales, debit to sales, 1,200,000, and to credit purchases or cost of goods sold. And to credit purchases or cost of goods sold. Okay? Then, second entry will be to debit retained earnings of P or Puma, debit retained earnings of P or Puma, 36,000, and to credit cost of sales, and to credit cost of sales. Now, this is just to recognize the realized income on the beginning inventory that we credited to inventory at the end of 20x4. So that 36,000. And the second entry is to debit cost of sales, that's on the ending inventory. So to debit cost of sales and to credit inventory. Okay? And to credit inventory. We are given the amount of unrealized profit in our computation. Number 1, we computed for the unrealized profit in the amount of 50,000. So how did we get the 50,000? As stated in the problem, the ending inventory contained 1/4 of purchases. And the purchases during the period was 1.2 million. So if you multiply that by 1/4, that's equal to 300,000 pesos. Now, how much is the billing price for that? Okay? So the billed price is equal to 300,000. That's the billed price computed by multiplying 1/4 by 1.2 million. The cost of that is taken by dividing 300,000 by 1.2. By dividing 300,000 by 1.2. So you have the 250,000. 300,000 minus 250,000, that gives you 50,000. Okay? So that's the amount in your last entry. Debit cost of sales, 50,000, and to credit inventory. In the amount of 50,000. In the amount of 50,000. Okay? So that gives us now your elimination entries with emphasis on downstream. Maybe class, what I'll do is to give you one problem on downstream. That's problem number 3. and give you one problem on upstream. Then after that, it will already be 11:40. I'll just give you the letter answers to the multiple choice problems. Okay? So we now go to problem number 4. I hope you are following. Problem number 4, let's try to finish. In problem number 4, regarding upstream sale, working paper, eliminating entries, and consolidated net income. The company owns 90% of the common stock of Simplex. Simplex company sells merchandise to Pinta at 25% above cost. During X4 and X5, such sales amounted to 800,000 and 1,020,000 respectively. At the end of each year, Pinta Company had in its inventory one-fourth of the amount of goods purchased from Simplex during that year. Pinta Company reported income of 1.5 million in 20 X4 and 1,720,000 in X5. Simplex reported net income of 600,000 in each year and did not declare any dividends in either year. There are no intercompany sales prior to 20 X4. So number 1, calculate the non-controlling interest, the controlling interest, and the consolidated net income. Number 2, the journal entries. And number 3, still the journal entries. Now, you will notice that the sequencing of the requirements in the problem similar to problem number 3. Okay, so let's start with requirement number 1. Finally, computing for the consolidated net income. So we now begin with uh, P or pinta, ha? Karon ang ato naman nga pinta, P. And then simplex, S. Consolidated net income is to be computed only for 20 X5. We begin with P company's net income from separate operations. The amount of 1,020,000 X5. 1,000,000, I mean 720,000. That's in 20 X5. 1,720,000. That is its income from separate operations. Okay. Now to this amount, we are going to add S company's net income from own operations. S company's net income from own operations amounting to 600,000. Amounting to 600,000. Okay? Next, we are going to add realized profit in beginning inventory for the upstream sales. Now, let me give you the figures. We will have the computations again at the end. So, we have now your P company's net income from own operations, 600,000. Then, realized profit in beginning inventory of P company for the upstream sales, 40,000. Realized profit in beginning inventory of B company, 40,000. Next, unrealized profit in ending inventory of P company. Unrealized profit in ending inventory of P company. Deduct 51,000. 600,000 add 40,000 minus 51,000. The difference is 589,000. 589,000. We add 589,000 to 1,720,000. 1,720,000 add 589,000. So we get the total of 2,309,000. 2,309,000. Then we deduct the non-controlling interest in net income. We deduct the controlling equal to 58,900. 58,900. Okay? So we now get your controlling interest is 2,250,100. 2,250,100. That's now your controlling interest. So the controlling interest is 2,250,100. How did we get the non-controlling interest of 58,900? How did we get the non-controlling interest of 58,900? So we begin with S company's net income. S company's net income of 600,000. We add realized profit of 40,000 and deduct unrealized profit of 51,000. So we have the realized net income of S from own operations, 589,000. And then we multiply that by 10%. The different or the product is 58,900. So that is the non-controlling interest in net income. The non-controlling interest in net income of 58,900. Okay, now we go to the journal entries again. Journal entries in the box of Pinta or P in 20x4. First, we begin with the cost method. Under cost method, you have no entries, no dividends to be recorded. Cost method, net income of subsidiary, not considered in the investment account. So we now begin with requirement number 2, equity method. Equity method. And requirement number 2, under the equity method, let's begin with 20x4. 20x4. The first entry in 20x4 is to debit investment in S. Investment in S. For 600,000 times 90%. Investment in S, 600,000 times 90%. So that's 540,000. Credit equity in subsidiary income. Credit equity in subsidiary income. So repeat, 20x4 under the equity method, debit to investment in S, 540,000, and credit equity in subsidiary income. In 20x5, the entries will be, to debit investment in S for 36,000, investment in S for the amount of, actually the unrealized profit is to be debited. So investment in S for the amount of 36,000. That's 90% of 40,000. And credit equity in subsidiary income in 20x5, no? Oh, by the way, I'm sorry, in 20x4. I'll repeat. Under the equity method, the entries in 20x4 are: first, debit investment in S, 540,000. Credit equity in subsidiary income for 540,000. The second entry in 20X4 under the equity method is to debit investment in S for 36,000 and credit equity in subsidiary income. Investment in S, 36,000 and credit in equity in subsidiary income, 36,000. Now let's go to 20X5. In 20X5, we again debit to investment in S, 540,000 and to credit equity in subsidiary income. Under the equity gapon ha, debit investment in S, 540,000 and to credit equity in subsidiary income. Still in 20X5, the entries are debit to investment in S for 36,000 and to credit equity in subsidiary income for 36,000 and to credit equity in subsidiary income for 36,000. Second entry now for 20X5, debit investment in S, 45,900, debit investment in S, 45,900, and to credit equity in subsidiary income, 45,900. Now, for the last requirement, number 3, prepare journal entries for the consolidated working papers. Now, let's have your upstream sales in number 3. Okay, what are the entries? For the upstream sales, the first entry is to debit sales 1,020,000. Debit sales 1,020,000 and to credit purchases or cost of sales and to credit purchases or cost of sales. To eliminate intercompany sales. To eliminate intercompany sales. Then, the second entry will be to debit retained earnings. To debit retained earnings, P, 36,000. Debit retained earnings, P, 36,000. Debit non-controlling interest, 4,000. Debit non-controlling interest, 4,000. And credit cost of sales for the beginning inventory. And credit cost of sales for the beginning inventory. Credit cost of sales for the beginning inventory. Okay? Now, for the amount, no? So again, I'll repeat number 3. Number 3, first entry, debit sales, 1,020,000. Credit cost of sales or purchases for 1,020,000. Amo na ang number 1 entry and requirement number 3. Second entry is to debit retained earnings, P, for 36,000. Debit kapag class non-controlling interest or NCI by 4,000 and credit cost of sales 40,000. I'll repeat, debit retained earnings P, 36,000. Debit non-controlling interest 4,000, and to credit cost of sales by 40,000. So debit retained earnings, surge 6,000, debit NCI, 4,000, and to credit cost of sales by 40,000. Second entry, okay, what will be our second entry now for the last entry? Debit cost of sales, 51,000. Debit cost